Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to the stage. He will be talking about early call option exercise before an ex-dividend, and he's going to explain that. So welcome, Dimitri, to the stage. How you doing, D?
Good morning, Will. How are you?
Excellent.
Good morning, everyone. And today, what we'll do is talk about early exercise of a call option. Why would you want to consider an early exercise? And it's an important feature for options traders because there could be times where you have that option to exercise your call early before expiration, and there might be a real economic benefit to doing it, and it's part of trading efficiently. It's part of maximizing your profits, reducing your portfolio risk, and you would have to understand, when would you want to do that, right? So we're going to go over a scenario here, or an example of one instance where, as a trader, you have to pay attention and consider, if you have a call option in a particular situation. We're going to look at ex-dividend. Do I exercise this option early? So let's first find some ex-dividends or upcoming ex-dividends, and then we're going to go to the options chain and kind of discuss it. So I'm going to come up here under stocks, and we're going to look at the dividend calendar. So I'm going to click on dividend calendar, and obviously for you to exercise a call prior to the ex-dividend date, that means the stock hasn't gone ex-dividend yet. It's going to go ex-dividend, the following day. So if the stock already went ex-dividend, if you exercise it, it's not going to help you anymore because you're not entitled to the dividend anymore, right? You're only entitled to the dividend if you own the stock prior to the ex-dividend date. So let's go here, move to June 20th. So I'm going to move up in our calendar, and here are the stocks that are expected to go ex-dividend. So McDonald's is expected to go ex-dividend with an amount of $1.77. Okay, so let's go to McDonald's and look at that option chain for a second. I clicked on McDonald's. We ended up here on the McDonald's main page. I'm going to go under options. I'm going to click option chain, and then I'm going to close this menu to expand the screen. So if we're looking at the option chain and we own an option, the first thing is what we don't want to do is exercise an option that has time premium, okay? Because if you do that, you're kind of giving up that time premium. You're giving away that time premium. You're better off selling the option. So, like, for example, over here, if I'm looking at the 312.5 call, well, this option is out of the money. The stock is 311.75. So I don't want to exercise that option, because what will happen is I'm gonna end up buying the stock at $312.50. But that's below where I could buy it in a spot, right? I could buy it at $311.75. So why would I want to exercise my option to buy it at a higher price. That doesn't make any sense. So you wouldn't want to exercise an out of the money call, because that would force you to buy the stock at a higher price than the market. And if the call is in the money, let's say like a 310, right? So if we have a call that's 310, well, yes, if I exercise it, I'm buying it below the 311.75. So from that perspective, it's in the money. But if I look at the premium is bid 228, right? So that at least let's look at the bid. If the bid is $2.28, well, if I add 228 to 310, that's 313.28, right? That's above the 311. So this has actually time premium, right? The bid itself, it's above parity. So I'm better off not exercising the option. At that point, I'm better off than I could just sell the option, collect my $2.28, and then I could always just go buy the stock in the market, 311.75. So I wouldn't want to exercise that, because I could do the same thing, just go buy the stock. I don't need to exercise my option. I could just go buy the stock, and by selling the option, I'm better off, because I got that time premium. But as we go out further, let's say here 290. Well, now I'm faced with the situation where, okay, the stock is 290, right? And if I own this option, if I sell it, right, 290, I get $20.10. So by selling it at $20.10, like if we add $20 to 2090, that's what, 110, right? That's my math, right? Well, that's below parity, right? That's below where I could just, instead of selling my option, I could just exercise it at 290, end up buying the stock. I forego the 2010, but I could go and sell it at 311.75. So would it make sense to go sell an option below parity? That becomes an exercise, right? That becomes a potential candidate for an exercise, because I would rather just convert it to stock, exercise my option, convert it to stock, and then I could just sell the stock if I want to be out, right? Instead of just closing my position by selling the option, I could convert it to stock and sell the stock. And I would receive more for that than if I just sold the option. Okay. So that becomes a potential early exercise, but I don't necessarily need to do it right away, right? I could wait, unless there's a benefit. And in this case, let's say there's McDonald's goes ex-dividend June 2nd. Well, that means that if I want this dividend of $1.77, I need to own the stock, okay? Because the option doesn't pay a regular dividend, right? So when you have an option, right, it's a contract between two people, and sometimes if it's a special dividend, they'll adjust it, but a regular dividend is not included in that contract. And the McDonald's itself, the company, only pays dividends to shareholders, right? They're not obligated to the options market, because the options market are contracts between traders. McDonald's has nothing to do with your contract with another trader, so they don't owe you a dividend. And here you have this situation where you're like, okay, if I don't exercise my option, Well, what will happen is I don't get this dividend. That's the problem, right? I'm not going to get this dividend. And what will happen is my option will go down by that ex-dividend, right? Because once a company pays the $1.77 dividend, well, the stock will get adjusted. The company's had this much in the bank, so it has this valuation. Now it doesn't have that in the bank. The valuation goes down. So basically, my option gets adjusted with the stock, and I don't get the dividend. That's going to be like, foregoing $1.77. So that's where it becomes, well, do I exercise this call? Now, the question would be, well, if I exercise this call, right? Well, I'm no longer risking $20, right? Because let's say I have a call option if the stock drops, right? So let's just click on that. So this is what it looks like at here. I'm going to expand this. So a call option, right, protects you from a severe drop below the strike, because you're limited to the value of that call. And that means, well, if I exercise that option, I give up that benefit, right? Because now I have a stock that I'm buying for $290. If it goes to zero, I lose that $290. So that's where you have to do a little bit more analysis and see, well, can I recreate this and still make a benefit creating a synthetic call? So what will happen is, let me close this. What happens is, if you exercise this call, you bought the stock at 290, right? So that's what 290, and you gave, obviously this 2010 goes away because you can't sell it anymore. So in effect, you bought it 290 plus whatever, the price of this option is. But now you have this position, you get the dividend, but you have that downside risk. But I could also limit my downside risk, because at the same time as exercising that call, I could limit my downside risk on the 290 strike by buying the put. Right? So I could go here and say, okay, well, I own the stock. If I'm worried about that 290 strike, well, I could go buy the put for 3 cents. Right? So what will happen is, now this is what you're going to have. You're going to own 100 shares of stock for every call you exercise. But you also went and bought the 290 put for 3 cents. So your position, again, will look like a synthetic put, right? So a synthetic call, sorry. So you're still protected with this stock input below the 290. But what you did was you paid 3 cents, right? So now we paid 3 cents for this position, but at the same time, now that we own the stock, we should receive $1.77, right? So what we did was we recreated a synthetic call, but by recreating the synthetic call, as traders, what we did was now we received the dividend of $1.77 minus the 3 cents we paid for the put. So in effect, right, we got $1.74 extra that we wouldn't have gotten if we did nothing. Okay, so that's kind of when you're going through and looking at well, Well, by the way, this May 30th will expire today, so that won't matter if you exercise it or expire today. So you would have to look at like the June 6th or whatever options. But obviously you could have anywhere. Let me just show you open interest. Let me see. So obviously there are people here with options that are potential, that could be potential exercises. So again, what we did here was we looked at a situation where we have this early exercise ability, the option to have early exercise, and then we ran into a situation where it might be economical. So how do we go through and that analysis to see if there's a real benefit to exercising early or holding on to that option? So I'm going to stop right there.
AD, that was awesome. Thanks for bringing us that webinar. This is actually the last webinar of the week. It is Friday. Great job as always. Everyone have a great trading day. D, thanks so much for this webinar, my friend.
Yep. Thanks everyone for joining. Stay safe out there, and we hope to see you Monday.
All right. Great job, D. We will see you next week. We'll have a show on Monday. Everyone have a great weekend. Thanks for joining us. Trade in peace, chameleons. Everyone have a great day. Bye-bye.